Hello everyone and welcome back to another episode of Market Bytes. We're going to discuss the latest retail investor beat today, and I'm joined by our usual guest for this topic, Brett Kenwell. Brett, how are you doing?
Doing well. Enjoying the last bits of summer. How are you, Sam?
Yeah, not bad. Not bad. Just before I got on this recording, and it's 3:30 in the UK at the time of recording, it was absolutely chucking it down. Like one of those days where you're like, okay, this is autumn now. But in the last 5 minutes, the sun's come out, it's shining, there's blue skies. So hopefully that's a positive sign. But it does feel like the end of summer, doesn't it? And yeah, fingers crossed we can have a little bit more summer sun. You're logging in from New York today, is that right?
Yeah, we're coming in from New York. It's been a really nice week. Like you said, September is beautiful. You start to feel sort of the crisp air, and it starts to feel like fall's right on the doorstep, you know?
Yeah, absolutely. And the Premier League is back this week, so Arsenal are back on my TV. I'm happy. The markets are, for the most part, up. Everything is good in the world. But I mean, let's get into it. I mean, there's been some pretty interesting results from the last quarter. I mean, I love this survey. I think it's good to really see what retail investors are thinking, right?
Yeah. We do the survey obviously every quarter, every couple months, and we ask some some of the same questions, so we kind of get the consistency quarter to quarter to see how things are changing. Then we throw in some interesting, some fun questions. Maybe you can talk a little bit more about just the survey in general, sort of some of the parameters around it.
Yeah, absolutely. Before we get into the results, so it's based on 10,000 retail investors across 12 countries. They don't need to be an eToro user as well, which I think is cool. We're really getting a broad range here. We asked them quite a lot of questions. Some of the countries: UK, US, Germany, France, Australia, Italy, Spain, those kind of countries, and then other regions in Europe: Netherlands, Denmark, Poland, Romania, Czech Republic, and it's carried out by a company called Opinion. So we use them every quarter and gather that information, run through a big list of questions actually, and then obviously we'll discuss some of the key findings. But I've also, for those watching or listening at home or wherever you are, I've got the list of all the questions. So throughout the conversation, Brett, I'll just pick some out and discuss them in relation to what we're talking about. But I guess one of the main topics, and for anyone that's already read the press release that's gone out, would have looked at what's going on in the US and what those biggest takeaways were. So is it okay?
Yeah, it's I'd say it's more than okay. Retail investors, so we did the survey from August 5th to the 19th, so very firmly
Hmm.
mid August, midsummer. Um, at that time we had markets are at record highs, but we'd have had some weakening jobs data, some you know concerns about the macro front, but we're on the doorstep of a rate cut. The markets have done really well from the April lows, so there's sort of a lot of dynamics in the air. But when you look at the confidence from U.S. retail investors, it's all so high, and that confidence really stretches from everything from whether they're on track for their financial goals, confidence in their portfolios and their investments, confidence in their jobs, in their income and living standards. So really, I mean, it wasn't just one or two things where it was a modest uptick. It was a very significant increase. I think, and maybe this is a little bit plays with the sentiment and how sentiment can shift in markets. Sentiment gets bearish in tough markets and rather bullish in good markets. But you look at something like confidence for the U.S. economy was only 13%
Mm.
last quarter, and this quarter it was 26%, or not confidence, sorry, very confident was the response, and 26%, so it doubled quarter over quarter. It was the highest reading we've ever had. Most of the confidence readings were the highest we've ever had. So I think stuff like that really stands out, and maybe it's a little bit of investors' portfolios moving higher. Maybe it's a sigh of relief in terms of tariffs that didn't really pan out the way the worry was maybe in Q1 or early Q2. But we really saw that confidence come back, especially on the U.S. side, which was reassuring.
Yeah, and you know what? I mean, I think we mentioned this last quarter, but I think it's poignant to talk about it as we're in the ninth month of the year now. We've obviously had a dip to start, I think the S&P was down more than 15%. The Nasdaq was down more than that. There were some individual stocks that were down quite heavily, and retail bought the dip, in those sort of end of March, April lows, whilst a lot of institutions stayed on the sideline. And I remember quite vividly, and Josh and I talked about it on a previous podcast, and discussed, there was an article from the FT, and it was like, who's going to win, institutions or retail, with buying this dip? And the article and some of the comments were kind of like, it's not going to be retail. Well, right now the answer is retail. They're absolutely flying at the moment. And that's not to say the market isn't going to top out here. Of course it could do, but I can completely understand why that confidence is so high at the moment. And as you mentioned there, some of the percentage returns, the quarter and quarter gains as well, and pretty good. A lot of exposure obviously to the US in people's portfolios as well. And you mentioned there, people are pretty confident about the sort of that job security as well, and their investments that they've managed this year. And I think obviously it's easier to be confident when, in theory, a lot of the stocks and equity markets and ETFs that you own are positive, right? It's been overall a good year, especially if you did buy that dip. I also know there's a lot of money sitting on the sideline as well, and sort of money market funds. I think it's a record high at the moment. So there's obviously still a lot of people that maybe did miss the sort of the dip out and the bull run we've had since then. But I can completely understand why confidence is up there. I would say it would be interesting to see in 3 months' time the next sort of set of results, because we're going into a period now, and we're recording this on the 11th. You've got the Fed meeting on the 17th, don't we? It looks like it's going to be 25 basis points, could be 50. But then what happens after that? What's going to be the next driver? Is it going to be another one in December? Or, is the labour market going to deteriorate more in the US? Does that change things? So I actually think it's, and in fairness, we say this every 3 months, but the next 3 months are going to be interesting. They're going to be exciting, aren't they? And, I think in summary, and I think you would agree with this, it kind of makes sense why people are pretty confident, right?
Yeah, I mean, I always think, when it comes to markets, especially, there's always things to worry about. There's always a concern. There's always a this could happen or a that could happen. But, largely speaking, things have stayed pretty stable. Corporate profits have been strong. Stock markets have been strong. The economy as a whole has held in. It's not to say it's perfect or firing on all cylinders necessarily, but I think kind of that relief that came out of Q2, really that kind of that March, April span specifically, there was a lot of worry there, I think, from consumers and retail investors. And we haven't really seen the worst case scenarios pan out. In a lot of cases, we've seen the best case scenario pan out. So I think that's just really paved the way for confidence there.
Yeah, absolutely. I mean, one of the questions which links back to the US that we asked was, currently the US dollar serves as the global reserve currency. Which of the following statements do you believe best describes what will happen in the global reserve currency over the next 10 years? And the top answer was the US dollar will weaken but continue to serve as the global reserve currency, which makes sense, doesn't it? And we have seen dollar weakness overall this year and a bit last year as well. But for the most part, people do believe that it's still going to remain that global reserve currency. And I think, I certainly agree with that. You had 10% people weren't sure. Another 28% people, the US dollar will remain the global reserve currency as it is. The US dollar will strengthen and continue to serve. So some people actually think the US dollar will strengthen, and 22% of people thought that. Interestingly, they asked people, if you did think that it won't be the US dollar, that is the reserve currency, what would it be? And I asked people at home or wherever you are listening to guess what would be the most common answer. Think in your head, say it all out loud, and it's actually very, very close, to be honest. You had Bitcoin 25%, the Chinese yuan 25%, the euro 25% of people, and then gold 23%. So those were the sort of the top ones that people answered. And then you have 16% of people said central bank digital currencies, and then you have all the way down at 3% real assets like real estate infrastructure. Can't quite see how that would happen, but I guess, I mean, there will be some Bitcoin enthusiasts out there that maybe think it could happen, but Brett, not in my lifetime. I don't see it happening. You?
No, I think that's kind of the consensus with the survey results too. It's a very small percentage, think that it'll be kind of destabilized to that point. The dollar, the currencies will always shift around,
Yeah.
devalue or increase, but in terms of being replaced, it's hard to imagine that scenario happening without a lot of volatility and a lot of fallout if that plays out.
Yeah. But one thing is for sure, if it does happen, they're going to clip us talking about it like this. But let's move on to our next subject, another popular one, of course. And we wanted to know how investors feel about tech stocks. Did anything for you particularly stand out from their answers when it, talk about tech, or I guess specifically the Mag 7 as well?
Yeah, so one thing that really sticks out to me, and it's actually pretty consistent in these surveys, is this quarter's not too much different from the others in the sense that in terms of the sector that the investors have most exposure to is financials or financial services. That's the number one over tech, which surprises me. I would always expect tech to take the leadership role, but the follow-up question to that was, what sector are you most likely to increase your investment to in the next several months? And that was tech by a healthy margin. 25% of respondents said tech. Financials was the next highest, and that was only 10%. So investors really kind of focusing on that group. And then, as you mentioned with Mag 7, if we dialed into Mag 7, Amazon remains the favorite, the heavy favorite in the group. Almost 30% of respondents said that they already own or most likely to increase their allocation in Amazon. That was followed by Apple and then Microsoft. And we actually asked this question a year ago, the same quarter, 2024, and it was the same three stocks in the same position. So a lot of consistency there with investors, which I think surprised me a little bit, just in the sense of, well, first, I'm surprised NVIDIA wasn't higher.
Mm.
It wasn't in the top three. That sort of surprised me. But we also tend to see, I feel like, a lot of rotation within the Mag 7, just in terms of their performance. It seems like investors, institutional and retail, kind of shift their preference within the group depending on, I don't know, sometimes it's valuation, sometimes it's, product or what's in the news. Like Alphabet's had so many headlines this year, and that can impact it. But I'm surprised we didn't see a little bit more rotation within that group this last year.
Yeah, I'm with you. I actually saw someone, I think it was tweet, post on X, whatever you want to call it these days, the other day, saying we shouldn't call it the Mag 7 anymore because it's the Mag 8, because Broadcom has creeped into it, haven't they? They're overtaken Tesla by market cap. Mag 8, they have to come up with a different name. I'm sure they
Well,
will
if
if it
Oracle keeps
remains.
going, it'll have to be Mag
Well, I
9.
know. Yeah, I mean that is flying up to 12th. That is up three places. I'm just having a quick look at the market cap companies at the moment. Nvidia 4.3 trillion, which is zero point 0.6 trillion above Microsoft in second there as well. But yeah, no, I was a little bit surprised about that. But at the same time, like you said, with the currency aspect, things are going to fluctuate. And that could be one earnings report in a quarter, it could be a headline, it could be tariff related at the moment. So yeah, interesting nonetheless. But one thing I thought would be interesting for us to discuss is a little bit about Europe, and it kind of ties into how maybe some are feeling about diversification, because there will be some people that rightly see that the US is sort of regaining that center stage, and we've seen increases year over year or quarter over quarter, whatever. Europe, for the US, I understand that is the main one. But for those that maybe did want some exposure elsewhere, is it Europe? Is it China? And there was a question: which of the following countries / regions, stock markets, do you currently have exposure to in your portfolio? Europe actually dropped a tiny bit, very similar to quarter one and quarter two. It went from 53% to 51%. The UK dropped 1% from 17 to 16. Emerging markets was up 2%, up to 15%. Australia is 12. China 10. I mean, China's had a good time recently, hasn't it? And it's funny with China. I mean, I've talked about a potential Chinese recovery over the last sort of couple of years, and I've always said it feels like it's going to happen. Just no idea when. And this year it seems to be the time where it has gone higher. But I can understand people looking to play that sort of diversification route as well. I'm just having a quick look now at the results we've got in terms of asset classes. Domestic equities ticked up a little bit, crypto ticked up a little bit. Fixed income, domestic bonds up from 36 to 38%. So, having a look in terms of the assets that people hold, financial services, healthcare, technology, all sort of in those top three by sectors. So people are pretty diversified. I would say retail investors are pretty diversified anyway. I have to say, looking at the report, going through it, and people can obviously check out the PR release, I kind of feel like retail investors are doing okay at the moment.
Yeah, I think so too. When we did this last quarter, we saw such a big uptick in some of that diversification, or at least on
Yeah.
the U.S. side, we did. A lot of investors, I think, saw, how poorly the Nasdaq and S&P were doing relative to, the DAX or UK markets or French markets or China's market. The U.S. was really lagging a lot of those groups, and then if you go outside of equities, even you saw how well gold has done really this year, but really over the last 5 to 7 years, gold's been such a strong performer. Same, you can say the same about Bitcoin. I think investors kind of see they realize the S&P is not the only game in town, and they start to go to those other areas and diversify around. And in that sense, 2025 has been a really rewarding year for them.
Yeah, no, it has. It has. For anyone on the podcast, the link is in the bio, by the way, for YouTube, and it's quite funny because Brett is being an absolute professional as his camera decides to go up and down. It's amazing. Do check it out. You'll have a good laugh. We'll move on to the back end here as well, just of the podcast and the chat. But just before we talk about a few more points, there was a couple of interesting questions. And again, for those at home, have a little guess to yourselves. And the question was, which, if any, of the following do you find most difficult to understand when it comes to investing? A big list was given to people here, and they could obviously do multiple choice. Crypto and blockchain technology, 34%. And I guess if you're bullish crypto, the fact that a third of people find it really difficult could make you feel a little bit more confident about the whole place, that it's early on. Maybe if that number was really low, you'd think, okay, well, everyone understands it as, maybe the upside is capped for a bit. So I'd spin that as a glass half full rather than glass half empty. Tax rules, 26. AI powered investment strategies, 23%. And the next question, which was quite interesting, is which, if any, of the following investment topics do you plan to learn more about in the next 12 months? And AI powered investment strategies was up there, number one, 23%. Crypto was 22%. And I think 58% of investors are open to letting AI tools like your chat GPTs or Tori, for example, on eToro make decisions, with millennials and Gen Zs especially keen. Those older crowd less likely, but you kind of would expect that to be the case. And just also on that, we can discuss your view on that in a moment, but also some long-term themes as well from the thematic investing standpoint. Clean tech, digital transformation, and crypto dominate with 80% of respondents tying long-term themes to future returns, diversification on personal values there as well. And also some investors frame thematic investing as aligning with values like sustainability rather than just returns too. But just on the AI stuff, as I said, 58% of investors open to letting AI tools like ChatGPT make decisions. Do you think, and it's a complete guess, I appreciate, do you think that number goes up over time?
Yeah, I do. We're still pretty early in the AI cycle. Right now, it's, LLMs have dominated sort of the AI discussion, but people are becoming more familiar with not only what AI can do now, but what it could do in the future. And, it's just natural for, I think, that to eventually work its way into the financial markets. I mean, obviously, it's being used in some capacities now, but eventually, I think that retail investors do get more comfortable with that idea, and probably in other ways of their life too. Whether it's financial, but maybe healthcare, maybe it's in
Yeah.
different areas they start to really let it kind of infuse its way in.
Yeah, no, I would agree with that. The breakdown: 72% millennials, 69% Gen Z, boomers, they're called, aren't they? Behind 35%, but it did creep up from 30% in Q3 of 2024. And then the follow-up question to that was, why are you open to letting AI technology such as ChatGPT pick your investments? This is obviously for people that said yes. And 43% of people said, or 43% of the answers were ticked for this one. I think AI is the future of investing. Other reasons, it will save me time on research. 30%, it will make better decisions than me. And I guess in time when people feel like they have more confidence in it, you can understand those being the answers that people gave at that time. So, yeah, interesting, I have to say. I mean, look, that wraps it up for this quarter. I'm already looking forward to the next one. And who knows? I think it's a very interesting point in the market at the moment, especially as we're 6 days out from that rate cut, the first one for a while. And things can change very quickly, can't they, in markets? So we've got the next quarterly recording, Brett. I think we're recording that in a couple of weeks, so we need to prep for that. So I'll see you then. But as always, thank you for joining.
Yeah, thanks for having me. Let's do it again.
Take care, guys. See you later.